let's talk about, let's go from that to some entirely different industry, the big banks of the United States.
Right.
And the question of whether they are good businesses, and the question of what's happened to that in the last few years. Are they as good a business as they were a few years ago?
No, no. The banks earn on assets. They don't earn on net worth. You calculate it eventually as to what they earn on equity or net worth. But assets are the earning factors, and they've changed the rules so that you have to have more net worth per dollar of assets. And obviously, if you have more net worth per dollar of assets and you're earning a constant amount on assets, your earnings on net worth go down. Now, they were ungodly profitable. The better ones were back 15 years ago or 10 years ago even, when they had high ratios of assets to net worth. And some of them even cheated in terms of having even more assets than the regulators would have allowed. And you had these sieves, as they were called. Citigroup had a whole bunch of them. So they were off balance sheet ways of even controlling more assets. But all of that sort of thing has been terminated, and now they've got much lower limits as to the assets to net worth ratios. And the bigger the bank, to some extent, the bigger the bank, the lower that ratio can be. So what was a very profitable business has been turned into a good business if executed well. It's a pretty simple business. I mean, you get your money cheap, very cheap. Wells Fargo will have $1 trillion roughly, or close to that, of depositors' money, and it's probably costing around 10 basis points. Now, most people think you get $1 trillion of money and pay 1/10 of 1% for it, would find some way to do something profitable. But the banks have always gotten in trouble on the asset side. They've never gotten in trouble on the liability side, basically. But they really haven't gotten in trouble too much on the expense side. But they go crazy occasionally on the asset side. And what they do is they start copying what their dumb competitors are doing. That happens in every business, but it's particularly virulent in the banking business. John Stumpf once said, I don't know why we keep looking for new ways to lose money when the old ones were working so well. But they do, and they copycat. That's a great danger in any business. I warn our managers against it all the time. If anybody comes to me and says, we want to do this because the other guy is doing it, I say, go back to square one and come up with a better reason. But human nature is such that you do want to do what others are doing. I one time was at a director's meeting where a leading property casualty insurance manager, a very well-known guy, was making a presentation to buy a life insurance company. And he was going through all these kind of silly reasons why they should do it. And he realized that the crowd was kind of catching on to the fact these reasons were too good. So finally he just threw up his hands and said, oh, all the other kids have one. And basically there's a lot of business decisions made because all the other kids have one.